do you think 2020 will be like? You looking forward to it? Be glued to your TV, all the debates. What will 2020 hold for mergers and acquisitions? Well, this panel discussion explores the latest industry trends, hottest sectors, and what to expect in the year ahead. And session moderator is Corey Masella. He's the managing director at UHY Advisors. Corey has 25 years of experience as an entrepreneur, tax and business advisor, and as a specialist in SEC accounting and audit services. He additionally has experience serving private equity and technology industry group, practice leader for a top 20 accounting firm, and has successfully guided his clients through over 350 transactions in all facets of mergers and acquisitions transaction cycles, and to help them make critical decisions and while ensuring transactions are strategic and seamless. But more importantly, Corey has received a few M&A Advisor Accounting and Due Diligence Awards in 2017 as Dealmaker of the Year by the ACG New York and the M&A Advisor. Please welcome this panel moderated by Corey on 2019 sector trends and the 2020 outlook. Corey?
So thank you for those kind words. I'm going to start out by letting my panelists introduce themselves. And I want each of you to talk about who you are, describe your active funds, those with funds, your AUMs, types of companies, investment focus, and what is unique about you and the fund. So start out, Laura.
First. All right. Good morning, everybody. Can you hear me? So my name is Lauren Mulholland. I'm a co-founder at Middle Ground Capital. For those of you who don't know Middle Ground Capital, it's not surprising. We are a first-time fund, so we're a relatively new name. We just closed on our first fund this past August. It's a $460 million fund, and we make investments specifically within the industrial markets and other B2B businesses within the broader industrial spectrum. We typically target businesses in the lower middle market. So for us, that ranges between about 75 to 300 million of revenue. And from an EBITDA perspective, it's about 10 to 30 million. One thing that's really interesting and differentiated about us is, our firm is truly operators investing in the middle market. A lot of firms say that they're operationally focused, and that is the case. But what's different about our firm is that in the leadership, there are 3 of us who founded the firm. 2 of us actually have started our careers on the shop floor, and I am not one of them, so I'm the most boring of all of the founders. But my 2 partners, John and Scott, started at Toyota. One of them was putting bumpers on Toyota Camrys when he first started out, and the other was in the engineering division there. So they rose throughout Toyota over 18 and 15 years respectively before moving into private equity to build out an operational team at another middle market private equity firm. And so the 3 of us, and that's where I met them, the 3 of us have been working together for 10 years almost. And so while we are a relatively new fund, our team has been together for a very long time. And we've now built our team out to about 21 people, which includes our investment team, our business development team, and our operations team, as well as our back office. Our headquarters is actually in Lexington, Kentucky, and our investment team is in New York, and that's where I sit.
And Heather?
Good morning. Heather Medlin. I'm a principal with Huron Capital. We're on the opposite end of the new fund spectrum. We've been around for 20 years. In fact, we just celebrated our 20th anniversary. We've raised 6 committed funds, totaling just over $1.8 billion in capital over the last 20 years. We focus as well on the lower middle market, though we define the lower middle market a bit smaller than Lauren does. We start around 4 or 5 in EBITDA and go up from there. From an industry perspective, we're a little bit more diversified. I would call us a quasi-generalist. We focus on, in addition to industrials like Lauren, consumer products and services and business services as well. Couple interesting, unique things about our firm. One, and we'll talk about this a little bit as we get into trends that we're seeing in the market, but we are a multi-strategy firm. So instead of raising larger and larger funds, as many do, we decided to remain committed to the lower middle market, and about 2 years ago raised a non-control minority equity fund called Flex Equity. So I guess you could say we're ownership agnostic for the businesses that we invest in. We can own 20%, we can own 100%. And then secondly, we're a buy and build shop, which I think we'll talk about even more on this panel today. We like that model of buying and then making add-on acquisitions to accelerate growth. Of the approximately 185 investments that we've done since our inception, about 75% of those have been add-ons to the existing portfolio. So certainly a key part of our investment strategy. We have about 30 professionals across the firm, and we all sit in Detroit, Michigan, though we do not invest in the auto industry.
And then there's Marvin Rosen, who represents 500, 1,000 PE groups?
We just need more. That's all I can add. Marvin Rosen, I'm a partner at Greenberg Traurig. I've been with that firm when it was very small, and today we're the largest law firm in the United States. And I was asked what I learned most about representing private equity funds and investors that invest in private equity funds. And my answer is, if I were smart, I'd be part of a private equity fund as opposed to a lawyer. But it is very interesting and a lot of fun to see a firm start, because we do fund formation, M&A, and regulatory and everything else, to see a firm start and grow and become bigger and bigger. And it doesn't necessarily have to be the size of assets under management. It could be the build and grow, what they learn, because today what I find is all the investors find that those with true operational capabilities do better than those that don't have operational capabilities. So with that, I'll be quiet.
All right. I'm just going to add something about the firm UHY. We're the 16th ranked global accounting firm and advisory services. In the U.S., we have about 20 offices, and we provide buy and sell side transactions. And annually, we probably are involved in close to 100 deals per year. So we're very active in the space. The range of services that we cover in the cycle of transactions, we work pre-LOI, your quality of earnings reports, tax structuring and advisory. We also work, pre-contract and with structuring post. We're also working on the PPAs, the purchase price allocations, the audits, the tax, and more importantly, we work a lot on consulting and integration optimization, advisory services, plus interim CFOs. We'll put them in play so that before the companies that you've purchased move on, you're able to seek out the CFO, because time is valuable, and you're going to close a deal, and you probably won't have one in play at that point. And our clients include private equity funds, SPACs, family offices, and high net worth individuals, strategics, and independent sponsors. And with that, I'm done. The pitch is done. All right, so let's get into it. So, I was going to give this speech about everything that's going on in 2000, where we are in 19. Obviously, everybody's talking about, we just had a whole conversation about politics, and, we got politics, we got impeachment hearings, we've got interest rates going the direction we weren't expecting, going down now. We've got, tariffs in play, and technologies like accelerating, where it's affecting everything and anything you're involved with and everything you purchase. So, I want to start with this first question, which is, what has been your experience during 2019 in terms of buying and or selling in this market, and were there any surprises? So, I'll start with Heather.
Sure. Well, I'll first comment a little bit on the market overall, and I think Lauren's got some good statistics too, but I was with an investment bank last week, and they were presenting some Baird deal logic stats on the middle market through the third quarter, and no surprise, deal volumes are up 9% in the middle market, and that's defined as transactions with enterprise values of $1 billion or less. And deal value is down about 11%. But I mean, I think the down part isn't as meaningful given that I think 2019's on pace to meet or beat the 2018 pace of M&A activity, which I think is no surprise given what we've all been seeing. And I think this activity and the accumulation of dry powder, low interest rates, as Corey said, all of those factors combined mean that valuations continue to rise. And I think Lauren's probably seen this as well, but if you look at a variety of different sources, valuations in the middle market range anywhere from, median valuations range anywhere from 10 to 12.5 times. It's funny, 2 years ago, I was telling Lauren earlier, I've been on an M&A update panel for 3 years in a row, and I've been saying the same thing about the market all 3 or 4 times, except for one thing. 2 years ago, I said 10 is the new 7 in terms of valuation. And this year, I've been saying 13 is the new 10. Unhappily, I might add, because I think Huron is a pretty disciplined investor in the middle market. So no surprise from a funnel perspective, if you look at sort of what Huron has done this year, our deal volume is relatively flat over prior year. We've issued about 20% less indications of interest as last year. So I suppose we're being slightly more selective or disciplined in determining which processes or transactions we want to go after. But our management meetings are down almost double that, 35% or so. So I think, 2 things are happening. 1, we're being more selective, and 2, we're just not competitive. And I think that's true. I think emerging funds, like Lauren's, are being particularly aggressive in deploying capital. I think the market and the lack of some kind of supply out there is creating a lot of demand for good quality assets. So, this year we have not closed a platform. We have 4 under LOI, which is great. A couple should close before year end. But more importantly, we've bought 23 add-ons. So I think a trend for us in 2019 is the year of add-ons. We've got another 10 under letter of intent behind that, several of which should close before year end. So far and away, and I think the SEC would probably not be happy with me saying this, but 2019 should be a record year of add-on activity for Huron. We're always going to do a lot, but 23 year to date is quite a few, and that's across 10 different platforms. So we're certainly seeing opportunities to make accretive add-on acquisitions, and those have ranged in size from a couple $100,000 to $5 million in EBITDA. So across the size range as well. But a broad observation on selling and buying, I think people are paying up for growth. And if you can't demonstrate growth in this market, I think you will be penalized. And that's where we're seeing sort of the division in terms of quality from, on both the buy side and the sell side.
Lauren?
I'm sorry.
Go ahead, Mark.
Go ahead, Mark.
What I see is a very competitive market out there. A lot of funds have raised record high amounts. Many of the funds keep increasing the amount they raise. Some funds, if you look back 10 years ago, were $1 billion, and today they're raising $16 billion. It's incredible. And what that creates at all areas, from the middle market to the higher middle market, to the large market, to the small market, is competitiveness. And what I've seen is many more deals when the process is an auction. A number of my clients that expected to win aren't winning. In a number of cases, we were one of 3 finalists, and one of the 3 just paid much more than the other 2 were willing to even consider. One of the things that I have seen in the market, especially in healthcare, is the regulatory component is very important. And oftentimes, the regulatory component sort of gets you to rethink the price you're paying because issues come up that you didn't expect. But I would agree with what you've both said and what I've seen. We represent lower end of the middle market, and the upper market. And I find the lower end of the middle market is easier to get a deal without being involved in a process. The larger the funds, the more difficult they become to win an auction or to source directly.
Lauren?
Yeah, I definitely agree with a lot of what Heather and Marvin said. I mean, I think one thing that's readily apparent, especially in the statistics that Heather mentioned, I mean, deal volumes are going up and overall value is going down. That just speaks to the number of firms who are doing the buy and build strategy.
Yeah.
I think that's a clear way to sort of get the growth that you need to be to be able to get the exit multiple, that you acquire the business for when you're looking to sell. The other thing I would say is pricing does continue to be at an all-time high. I think it's risen every single year since 2009. We don't really see that changing, frankly. I mean, as we think about the broader private equity landscape, as Marvin mentioned, fundraising continues to be strong. I think 2019 is shaping up to be at least in line with 2018 levels, and there does continue to be a lot of dry powder out there. And so a couple of those things will continue propping up pricing. The one thing that I will say is one of the reasons why fundraising has been so strong is when you look at the private equity asset class, it continues to outperform other relevant indices, including the public markets. But also, returns aren't going down. And so even though pricing is getting higher and higher, returns are not going down. And so that means that sponsors are finding ways to create value, whether it's through buy and build strategies or whether it's through operational improvements or a combination of the two of them. At Middle Ground, our strategy is more to buy a platform and then do strategic investments around it. So we're never going to do 20 plus buy and builds in a year. We're just not set up to do that. But we will strategically look to acquire 1 to 2 companies around a platform that we've invested and integrate those such that we're able to accelerate the company's business plan into a new product line or a new end market. And so, our pipeline is really more focused on platforms. As I think about the trends in our pipeline, it's really difficult for me to sort of compare it to the broader market because we are an emerging manager and we launched our firm at the beginning of 2018. So we were ramping up throughout the course of 2018. We actually brought on an individual to lead up our business development efforts at the beginning of 2019. And so, our pipeline has continued to grow. I think we've increased the number of deals that we've seen from 2018 to 2019 by at least 35% this year. And our activity levels are also up, but predominantly as we've grown the team. I mean, in 2018, there were 3 of us. Today, there are 21 of us. So you would hope that our activity levels are increasing. We have done 2 platforms already this year. We have a couple more under LOI, one of which should be closing by the end of the year. And those are really good numbers for us. I mean, we target doing 1 to 2 platforms per year. So to Heather's point, we are an emerging manager. We are actively looking to deploy capital. A couple of things that I would say in the processes that we've seen, first and foremost, surprisingly, we've been seeing more processes that aren't broad auctions, actually. Whether we're participating in them or whether banks are just telling us that they have this new strategy of doing more limited processes in nature.
They may just be saying that too.
Yeah, sometimes they're just, you guys tell us. But we've actually, we have ways of tracking that through some of the technology that we use in terms of how many people are seeing the deals that we've acquired. And 2 of the 5 deals that we should have closed by the end of the first quarter next year would be defined as a limited process, which is probably surprising to many of you in the room. But that is one of the reasons why we focus on the lower middle market.
Great.
It can create sort of outsized opportunity from a sourcing perspective. The other thing I would say is what we have seen, and we obviously invest with an operational improvement strategy. We're actually underwriting and working with our operating team to underwrite a plan that we will execute with the company post-close. And so we're not looking at a deal as if we're a strategic, but it's almost like a quasi-strategic where we're actually underwriting things that we're going to bring to the table. And so what that means is we can be very competitive when the opportunity set lines up with our skill set. And what we've seen is we are not able to beat out strategics from a pricing perspective, but for a lot of our sellers, many of whom are privately held businesses, one of them had been around for 104 years, price was not their top point that they were focused on when they were selling their business. And we've had a couple of businesses that we've acquired to date where we actually weren't the highest price. We were able to differentiate ourselves in other ways in terms of having the right experience to lead the business forward that led to us being the winner of those processes, whether it was a limited process or a broader auction. And so I think being able to tell your story to sellers and communicate a level of transparency and a skill set that they can either get behind through a role or perceive a better outcome for their employees is really important in this market.
Yeah, I mean, I would add another point, I think, to your operational focus. I think the days of financial engineering, particularly in the middle market, despite the high leverage levels, are pretty over, I think, given the elevated valuations. And so, I think firms have to be specifically focused on value creation strategies. And to Lauren's point, we focus on founder-owned businesses. We've only bought 3 companies from another private equity firm, so very often we are the first institutional capital that business has seen. And so we, like everybody else, has to take a very heavy-handed operational approach if we want to create more value. And that because that multiple arbitrage just doesn't exist anymore in this market. So I'd like to define 2019 for Huron as the year of kind of operational growth. I think private equity in general, industry operating partners are maybe the thing that was really trendy 5 to 10 years ago. Now everybody has them. We have 40 of them across our industry sectors, and they add a tremendous amount of value in certain ways on boards, making introductions to clients and new acquisitions, et cetera. But I think if you have to take one more step further in terms of that operational focus. And what we've done this year is launched an in-house operations team. So similar to Lauren, we hired 2 full-time former CEOs who are each functionally focused. One is the former CEO of Herman Miller, was there for 20 years. He's focused on strategic leadership, strategies across our portfolio companies and new opportunities as well. And the other gentleman is focused on operational enhancement and comes from, Alvarez and Marcel in the ops consulting background, but also a portfolio company or a PE-backed CEO. So I think that is also sort of where middle market private equity is headed. And I think, Lauren, your strategy in terms of your fund is dead on.
So I just want to add, so you mentioned the individual from Herman Miller. And so the individual, I was involved on the sell side, getting a company on the sell side ready. And they're in negotiations with that company. And I can tell you right now, that individual from Herman Miller was the one that turned it, that actually got my client to actually say, you're the right partner for them. And they've stuck with it, and that kind of, there's a lot of value added in that, and some confidence.
Being able to say, I sat in your seat, right? I mean, your partners
Absolutely.
can say the same thing.
Yeah.
It's tremendous in terms of partnership for that business owner and being able to see the growth, the accelerated growth by partnering with a firm, like us versus a firm, some other firm.
Or having somebody in there,
Yeah.
similar to your operational
Absolutely.
experience. So, and just stat-wise, in 18, it was 2/3 of transactions was add-ons. I don't even know what it is for this year, but I can tell you from my experience, it's got to be up.
It's 70%.
Yeah, that's right. I didn't know what exactly it was, but we've
of
seen
the
a
middle
lot.
market were
So,
add-ons. Yeah.
All right.
The investors today want to see a playbook when they interview the fund or when the fund comes in. And today, that playbook, as both of you have said, is buy and build. And the investors say, okay, buy and build. How are you going to do that? And there's a couple components of it. They want to know how fast you can grow, because in their own minds, the faster you grow, because there's such dry powder out there that you need to create value. And when you start off overpaying where the industry's higher, they want to know how you can grow fast. And they also, so that's the buy and build strategy. And there are two components to it. One component clearly is tuck-in acquisitions. The other, do you have a plan for organic growth? And what is it? And the third, that people are looking today, because some of the big funds out there, if you take a Blackstone today, one of Blackstone's pitches in the market is we're going to not only figure out those two things, but we're going to figure out how to cut costs, not necessarily employees.
Yeah.
So what can the fund do to go out and cut cost? And one of the things they find is get different service providers that are more competitive, take the portfolio company as you're growing and the tuck-ins and figure out how to save costs. Nobody will go out and say we're going to fire a lot of employees, because that'll get certain people not happy, especially if they're going to run for election. But if you have that plan, it'll make life easier, and everybody wants to understand that playbook.
So the next question out there is, have the quality of the deals presented to you met your expectations? And what have been the challenges of closing these deals? So, Lauren, you're in the midst right now. So.
I'm happy to start on that one. I think in the first half of 2019, we did see a lot of really high quality deals. Our deal flow really picked up, particularly in sort of the March and April timeframe. And then I think what has happened in the second half of the year is a couple of things. Well, keep in mind, first of all, that we are effectively a sector-specific fund, and so we focus mostly on industrial businesses. And within the industrial economy, there's an index that comes out monthly. It's called the Purchasing Managers Index. It's referred to as the PMI. And it comes out the first day of every month for the month just before that. And it really, what they do is they go out and they talk to about 400 different companies, and they speak to the purchasing managers there, and they get a sense for what the trends are in the manufacturing economy. And they come back and they give it an index. And if that index is greater than 50, it means that the manufacturing economy is expanding. And if the index is less than 50, it means the manufacturing economy is contracting. And what has actually happened throughout the course of 2019 is, since the very beginning of 2019, if you look at that index, the year-over-year comps from the precedent month and the prior year has been declining. And so that meant that growth was slowing, but it was still positive growth throughout 2019 up until August of this year. In August, the PMI index actually went below 50, and it's been below 50 since then. In fact, September was actually the lowest PMI index that they have seen, the PMI has seen, since 2009. And so what that indicates to you is that we are in a manufacturing contraction, which is somewhat interesting because the broader economy is continuing to grow. But what that has meant for our deal flow, to get back to the question, is in the second half of the year, we actually started to see our watch list grow. And so the watch list is, and as we're talking to investment banks in our regular meetings, we're always taking notes of the companies that are expected to come to market. And the companies that were supposed to launch in the third quarter of this year didn't launch. They're still sort of preparing to launch, which to us is a sign that their performance probably isn't as strong as it used to be. We also are seeing for companies that have launched and are in the market, or perhaps were already in the market before this happened, we are seeing some of those companies have a hard time having a hard time comping to budget and also to the prior year. And so what that means as you're trying to close a deal is the valuation gap between buyers and sellers is actually wider, unless the sellers are ready to accept the fact that their company is underperforming, and therefore they'll take a lower price than what they expected when they launched the process. And so you have to negotiate and navigate through that buyer-seller gap in order to win the deal. And it also makes it more difficult to finance. Because a lot of the lenders are looking for stability, and if you have a business that's comping negative month to month, it's just simply a little bit more difficult. It can still get done, and it might even change the way that you finance the deal. But those are a couple of things that we've seen in the processes that we've looked at that have created challenges for us.
Heather?
Yeah, I would say since we're a little more generalist, we look across sectors, and in fact, I think 60% of the IOIs we've issued this year have been in the business services sector. So that just tells you sort of where we're seeing probably the most actionable opportunities out there today, per a lot of Lauren's comments on the industrial side. But I would say generally speaking, quality has been pretty consistent. There have been a couple of situations, one very recently, where I think maybe because people are worried of an impending recession or downturn, companies are being taken to market maybe a little prematurely. So we had one situation where we went and visited the company, and it was very clear there was key man risk. There was one founder CEO who was pretty much playing every role of the management team. And it was also very clear that he was sort of in the sunset, phase of his career and wanting to lead the business. He wanted to be gone after 12 months. And so that created a lot of challenges for someone like us coming in. I think opportunity is great, but I think there's generally an amount of risk and opportunity you're willing to embrace when going into a transaction like that. So we're definitely seeing that. And then, of course, we're seeing, at least in one situation later this year, where we've renegotiated the purchase price a couple times due to some performance-related issues or trends. And then in one situation in the summer, we actually walked away from a deal that was days away from closing due to uncertain tariff situations. So I think all of those issues are creating some amount of uncertainty and challenges in getting deals closed in this environment.
So let me just say one thing. So one of the things is that we've seen is in the last 2 years, because of the challenges and the multiples being so high, we have had a tremendous increase in the amount of sell-side quality of earnings reports we've been involved with.
Absolutely.
It's become a demand, and so because no one wants to spend that time and resources going into a deal and not have something behind it and vetting all the issues that come about. So there is a trend coming back to try and alleviate, because the bankers are getting slaughtered in these situations.
Yeah. Well, I also think it speaks to speed and certainty of close as well. Like the competitive dynamics, they're actually feeding off of the sell side quality of earnings, trying to get ahead in a process,
Right.
leveraging what the company has already done in terms of due diligence ahead of a process. I think that sort of works both sides of the buy side equation. I also think that the valuation environment is creating some nuance in terms of what a good valuation is. So if we're having a conversation with a banker about a deal and he's like, well, I think, valuation expectations are reasonable. They're in like the 6 to 8 times range. My team's like, well, holy crap, what's wrong with the company? And I think that's a little scary, right? I mean, 5 years ago, we sold a company and we sold it for 8 times and we thought it was an absolute home run, and we're still talking about it today, and here we are like thinking what's wrong if it's only 7 or 8 times multiple. So I think that's creating some anxiety.
Especially on the services and consumer side.
In services and consumer side, and
So Marv, go ahead.
What I find is a lot of valuations today and what people are willing to pay are partially dependent on the industry. If you take technology, especially software, that has a big recurring revenue stream, people look at that and they say, well, if we buy that chair and roll it in, we'll have a different product set to upsell to our customer base. And what they look at is similar to you, to create a plan. And that plan says, well, if I pay 14 times and execute on the plan, I'm really paying much less. Mm-hmm. So in technology and software and even healthcare, the EBITDA rates are just off the charts. If you take something like industrial, which is a great opportunity, I think in today's environment, which goes down later, is a question, what happens to the industrial space if the China deal is completed or if the China deal isn't completed? And what are investors or what are private equity funds willing to gamble? So I don't know, this is more your area, but it appears if there's no China deal, that's better for the industrial groups in the U.S. But if there's a China deal, the question is, how do you evaluate the impact of all of a sudden lower tariffs and people buying more from places like China?
By the way, that was a great segue. So thank you for my next question. So let's talk about the competition for deals, because everything you said relates to who the competition is and who's going out there and making the purchasing. So, you know, you've got larger firms out there than both of you. You've got strategics, you got family offices going direct, you got family office consortiums, and you got independent sponsors. So there's a lot of competition out there. So, you know, I don't know who wants to take it first, but talk about the competition that you're going against, because in tech, it's going to be more in the strategic realm or a PE shop that knows it, but talk in your worlds.
Yeah, it definitely varies by industry for sure. I mean, within the industrial industry, there have always been strategics who are, you know, competing for assets. I think we've seen a consistent level of competition from strategics. I think because of the increase in the buy and build strategy that we've been talking about, we're also seeing more competition from some of the larger private equity firms. And then we do see competition from time to time from family offices. But if you look across the spectrum, there's some nuances to each of those. I mean, specifically with respect to strategics, I mentioned earlier at the beginning that a lot of sellers, especially sellers that have never sold their business before, and so you will have the opportunity to be first institutional capital, you know, they're not always looking for price to be, you know, the key selling point. And so while we do see more competition from strategics, and we have lost a couple of deals to strategics, we've also won a couple of deals where strategics were playing, even though we weren't the right price, so, or the highest price. And so I think that there is a little bit of a nuance there. I also think that from a family office perspective, while they're more engaged on the direct side these days, you know, that's a good and a bad thing for us, because we're able to bring a lot of our LPs, many of whom are family offices, into deals as co-investors with us, and that ultimately is a good thing for us because it helps us, you know, improve that relationship. It gives them insight into what we do on a daily basis, and they understand our model a little bit better, and then that's better for us for fundraising down the road. And independent sponsors, frankly, I mean, because we sort of have a minimum EBITDA of like 10 million and revenue of 75 million, it's more of a source of deal flow for us than it is a competitor. So, you know, overall, I would say competition remains constant, but it's while prices have gone up, I mean, I think that's driven a little bit more by just the availability of dry powder than it is really increased competition, perhaps with the one outlier of some of the bigger sponsors playing in our market.
Yeah. I would agree with everything Lauren said on the strategic, larger buyout front. I'll add a couple comments around family offices and independent sponsors. You know, we're viewing family offices, certainly they're out there. There's some more sophisticated, sort of well-established, more private equity-oriented family offices, and they're formidable competitors. We haven't necessarily seen that in processes, but I know they're there just from a market and, you know, networking perspective. I think we're seeing them more as partners, as Lauren alluded to, especially in our flex equity fund. They're a great, you know, because we can affect a change of control through our flex equity fund by bringing together two minority investors. And family offices, you know, if they don't have sort of an established portfolio investment team or management team, they love to invest alongside a more kind of, you know, resourced private equity firm, because, you know, they can sort of sit back and be a little bit more reactive, not as proactive. And so we partnered with the family office, the Polad family out of Minneapolis, on a deal recently where we effected a change of control for the business owner alongside an independent sponsor. And that's, you know, where the independent sponsor comes in, is that's great for him or her because they can play a little bit more of an outsized role, not necessarily economically or from a board control perspective, but certainly from a day-to-day, you know, strategic implementation perspective, if they've got two minority investors and not one big sort of traditional fund writing 100% of the equity check. And so that's where we've seen a lot of family office activity from a Huron perspective. On the independent sponsor front, it's sort of like a tale of two worlds a little. I mean, we have added consistently over 100 new independent sponsors to our database every year since like 2013. It is insane. I think another general stat, the McGuire Woods Independent Sponsor Conference has been extremely attractive, or I guess popular over the last few years. 3 years ago when this conference started, there were like 250 or 300 attendees. This past October, there were over 850 attendees. So that gives you a sense of the dramatic growth of people just coming in. And I think the tale of two strategies is this. One, you've got independent sponsors who want to partner with more of a traditional private equity firm who can help bring some resources to the table, accelerate growth. We really look at it as a proprietary source of deal flow, though. We want them to bring something different, unique, an industry perspective, an angle, a relationship with the seller, for example. And then there are those independent sponsors who want to be first-time funds. And a lot of people are doing this to sort of grease the skids with LPs, where they're attracting less private equity capital to their deals, but more traditional LP capital. And LPs are coming, and even family offices are doing this more and more, and committing capital, saying, hey, we've got you. We'll fund your first couple of deals as an LP, and then that gives them a track record to then base sort of a fundraising strategy off of. And so that's actually competition for us,
Yeah,
right?
that's a really good point.
But the independent sponsors who sort of just want to be independent sponsors and have an industry angle or some sort of operational capability, those are the ones we want to be partnering with. So,
A couple comments. One of the difficulties when you dip into a highly competitive market and what's happening today is you're going to end up with longer hold periods because you're going to buy, you're going to have to build, and that's not going to be as quick when you've paid 13 times versus when you've paid 7 times. So what's happening now is funds have to go back into the market and raise money. And unfortunately, what that means is they've got to get realizations, whether or not they really want to or not. So now the question is, what happens if you own a portfolio company that's growing 15% a year, 20% a year? You'd rather sit there and own it for 15 years, but you're going to go into that fundraising market. And unfortunately, there's no choice. At a period of time, you have to sell it. So the question is, what's happening today in the marketplace to try to accommodate that? And especially in the little higher end, what's happening is more private equity funds are selling to more private equity funds and rolling over part of their ownership because they own this company that they don't want to sell. But they have to if they want to go to a pension plan to get money that pension plan wants to see. So 2 things are happening. One thing, more people are looking at what they call perennial funds, long-term funds, and the people that play along with that are the family offices, which talk about being able to deploy capital long-term. So I agree with what you've both said. The one sort of difference, a lot of independent sponsors today are they love what they're doing. They love partnering with the private equity funds. But a lot of them are saying, it's such a pain. Every time I find a deal, I don't have the ability to commit. I have to find a private equity fund as a partner, and boy, it'd be so much easier if I were a fund. So a lot of independent sponsors today are starting to look at alternatives.
Yeah.
By the way, nice spectrum. You went from the lower, you
Yeah,
rose
definitely.
up to the higher ranks of the private equity environment. All right, so now we go to the crystal ball. All right? So going into 2020, what do you see as the biggest challenges for your firm in the industry as we have continued excess powder, continued high valuations, looming downturn, and if that occurs, will the valuations decrease? And we've got everything I could talk about in terms of politics, whether it's impeachment, looming election, tariffs. Who wants to be the crystal ball leader?
There is no crystal ball here. I'll start. I think it's sort of like, of the four things you mentioned, sort of the looming downturn in politics, I kind of view those as more episodic. And so, those things are going to happen, and, firms like ours are going to have to deal with the ramifications and on a deal by deal and, quarter by quarter basis in terms of how we go to market. I think the excess powder and high valuations is sort of a more fundamental long-term change potentially that we're all trying to figure out. If a downturn happens, or when it happens, I suppose, I'm not convinced valuations are going to fall to the levels we saw the last pre-recession period, and so, or last post-recession period. So I think, firms have to kind of figure out how to play in an elevated valuation environment, because I don't think that those valuations are necessarily going to come down with that excess liquidity in the market. And so I think that's more of a long-term sort of fundamental question and challenge that we have to answer going forward, whereas politics and the recession maybe are more near-term.
Yeah, and the fact is that all the sellers that are out there in the country clubs and what they're hearing, it's going to be hard to shift that expectation going
Agreed.
forward. We'll have to see. But go ahead, Lauren.
I completely agree with you in terms of the pricing dynamic. I think it's been, as we mentioned earlier, a lot of that has been driven by the levels of dry powder out there, and because of the overperformance of the private equity class, I don't see fundraising changing anytime soon meaningfully, and therefore I don't really see the levels of dry powder changing. So I do think that pricing, will continue to stay high. I do think that if we go through an economic recession, you may find pockets of opportunity, but generally speaking, I don't think it's going to have a meaningful impact on overall pricing for the private equity sector. I spoke a little bit earlier about kind of what's going on in the manufacturing economy, but at the same time, you look at the broader economy, and the broader economy continues to grow, and that's really been propped up by a relatively healthy consumer. And so I think the fourth quarter is going to be pretty interesting to see if consumer spending really meets the expectations that are out there. And the other thing that I think, and I was at a Hamilton Lane conference last week, where they kind of surveyed a number of GPs, and one of the things that they asked them was, what do you think about the chances of a recession? And more than 50% of GPs said that they did not think that there would be a recession next year. And what they also showed, which I thought was really interesting, is historically speaking, in the fourth year of a presidential term, and particularly when one is running for re-election, an economic recession is less probable for a variety of obvious reasons. And so the chances of, if you look at history, the chances of having an economic recession in 2020 are relatively low, and they sort of place that indicator at about 20%. That being said, there's a huge wild card in the room, and we see it in our deals, and we're seeing it in the manufacturing market already, and that is what will be the impact of these tariff wars. What have they been and what will they been? And will the tariffs cause a recession that otherwise was not meant to be? And so I think that's the question that we're really grappling with. And as a result, we're having to prepare all of our portfolio companies for the what if, and we're having to underwrite to the what if as well.
Yep.
I agree with both of you. A lot of people are questioning, will there be a recession? 50% say yes, 50% say no. The real question is going to be, will there be a recession if the tariff deal gets settled and interest rates stay low? If both of those happen, the chances of a recession is diminished dramatically in many people's minds.
You're leaving out the stock market and putting confidence out there, and everybody looking at their pension plans. So, yeah, how long that'll stay elevated, no one knows.
Yeah.
So, I'm going to leave. Does anybody have any questions they would like to ask? Go ahead.
The panel spoke about their models, and they also spoke about competition. Can they give us a perspective on the role of intermediary and how do they source their deals?
How intermediaries source their deals or private equity firms source their deals?
On both sides, just for the benefit of the audience, please.
You comfortable with that question?
Yeah.
Every day.
Yeah, every day. I live it and breathe it every day. Look, it's, I think part of what I talked about in terms of differentiation and strategy is what's helping people source deals more effectively. I think the more focused and specialized you can be, like Lauren's firm and a little bit like my firm as well, the more sort of early looks and velvet rope type meetings or even limited processes you can get. I mean, it's all about getting that look and making sure it's the right deal. So being able to define what that means and also have a strategy that's at least focused enough such that when you see an asset that you really like, you can do the types of things that will help propel you through that process. I mean, much like Lauren, we don't spend a ton of time with the big banks. We are definitely more focused on the tier 2s and the tier 3s in terms of the boutique banks and even the business brokers who maybe see or close 1 or 2 deals a year. And so that just takes a lot of footwork and a lot of relationship building. I think in this market environment where there are more and more private equity firms and more intermediaries and referral sources, having that relationship is tremendously important. We did a survey of about 40 investment bankers last year and asked them, one of the questions we asked was, what is your buyer list doing, to your earlier point? And 33% of them said it was decreasing because there's more knowledge out there in terms of what private equity, what specific firms are looking for, and also just less, I think, patience on the seller to deal with a 200-person process. People want something a little bit more bespoke and custom where they can allow people to run a little faster and harder in a process. And so figuring out sort of what your investment strategy is, what your differentiation is, so that when those opportunities hit your desk, you can react quickly and communicate your interest consistently throughout that process to more effectively position yourselves to win. So relationship and differentiation, I think, are the two biggest the answers. On the intermediary sourcing side, I think industry specialization is the trend there. I think more and more boutique firms are hiring specialist bankers. And at least I can tell you from a sell-side perspective at Huron, we value the industry perspective and the relevance that it brings to a sell-side process.
Yeah, the only thing that I would add to that, and I completely agree with the first 2 things that Heather said, is, from a sourcing perspective, we are starting to invest more in technology to help us prioritize where we spend our time, whether that's, CRM systems or deal tracking systems or firms that will allow you to sort of target add-on acquisitions. I mean, those types of technological resources have, there's been a lot more that have come to market over the
100%.
past 5 to 10 years. And so it's really transformed the way that you're able to source. And that's incredibly important in the lower middle market to middle market where we play, because the tail of intermediaries is so long. And I think there's I think we ran some numbers the other day. There's 750 intermediaries who have done a deal in our target market in the last 3 years. But there's 350 of them that have done it in the last 12 months. And so even covering that 350 is incredibly hard, especially because our BD person is really a role of 1, and then it's supported by me and one of our other partners. But when you think about having to stay in front of all of those other intermediaries that do a deal every 2 to 3 years, that could be a great deal. So you have to stay in front of it as well. So you have to be able to use technology to target and also to market
analyze
yourselves.
Yeah. I would also add proprietary deals. I mean, it's a word we like to talk about all the time. I would say firms who are focused and differentiated will have a proprietary sort of direct strategy. And I think, for an example, ours is a CEO-led market entry strategy. It's called Exec Factor, where we partner with the CEO ahead of finding any company, but we underwrite a specific investment thesis. So it's definitely a more thematic approach to investing. We will 100% of the time hire a buy-side advisor because the investment criteria and focus is so narrow for those buy and build opportunities that we we do find it to be a really attractive way to find proprietary deals. And then secondly, to your point on add-ons, retained buy-side, again, the buy-side firms is kind of a whole new market in the last few years. They're leveraging technology. They're leveraging, dedicated teams to do the types of stuff that we don't have the resources to do internally.
We're doing the exact same thing. I mean, we're doing kind of industry theses around a couple specific sectors within industrials so that when we're pitching to the intermediaries, we have an angle.
Absolutely.
And while it might drive some proprietary deal flow, it also drives that kind of limited process deal flow,
Yeah, that
which is just as helpful.
Yeah.
So yeah, you have to have a targeted approach these days.
All right, great. Well, we're out of time, and let's thank our panelists. They did a great job. Thank you all.